How a campaign is conducted. Individual chart studies part 1. After we have determined the position and probable trend of the general market and have examined the action of the various stocks to see which are most likely to go with and to lead the market as a whole, we must single out those individual stocks which are the best position for our purpose, which is to operate in harmony with the indicated trend. There may be times when we will see an opportunity to trade in an individual stock against the trend of the market as a whole. That is, we may find an issue whose action is so clearly indicating weaknesses in an otherwise strong market as to justify our undertaking to sell it short and vice versa in a comparatively weak market, for as we have seen from our studies before. All stocks do not move in harmony with the prevailing trend of the market at all times. It requires a high degree of skill and experience to know when and where it is safe to buck the general trend with long or short trades of individual stocks and fully developed self-control to execute, maintain and carry such trades to a successful conclusion. Therefore, it is best for you to operate in harmony with the prevailing trend and not undertake to make commitments on both sides simultaneously until you have attained proficiency by thoroughly learning all of the principles taught in this method and know how to coordinate these principles. When you have learned to take a wholly impartial viewpoint, unbiased by news, gossips, opinion, and your prejudice, you will realize that the stock market is like any other merchandising business. Those who understand it buy only when prices are low with the idea of selling when they are high. And they operate only in the stocks or commodities which they can move best. So they may secure the highest possible rate of turnovers of inventories. For the above reasons, in addition to the factor of comparative strength and weaknesses, we must learn how to judge the quality, vital factor of price movement and volume behavior of individual stocks and all of the phenomena associated therewith. To do this requires a knowledge of what goes on behind the scenes. A stock carries the earmarks of its chief sponsors. Its action usually indicates the character, methods, and ability of those who operate heaviest in it. Like individuals, stocks have certain characteristics with which one becomes more and more familiar as he studies intensively their past and current movements. The market is made by the minds of men, and all the fluctuation in the markets and in all the various stocks should be studied as if they were the result of one man's operations. Let's call him the composite man, who in theory sits behind the scenes and manipulates the stock to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do to understand it. Not all of the manipulators' move can be detected. Not all of the moves are made by manipulators. In fact, it does not matter to the tape reader or the chart reader whether the moves are real or artificial. That is the result of actual buying and selling by the public and bona fide investors, or artificial buying and selling of large operators. Most of the important moves in the markets are prepared, executed, and concluded. And it is my business to show you how a large number of these trading and investment opportunities may be spotted in time to take advantage of them. The preparation of an important move in the market takes a considerable time. A large operator or investor acting singly cannot often, in a single day session, buy 25,000 to 1 lakh shares of a stock without putting the price up too much. Instead, he takes days, weeks, or months in which to accumulate his line in one or many stocks. He prefers to do this while the market is weak, dull, inactive, and depressed. To the extent that they are able, he and the other interests with whom he works bring about the very condition which are most favorable for accumulation of stocks at low prices. Between A and M, While he is ready to go forward with his campaign, he waits for a favorable market and then proceeds to mark the price up gradually or rapidly as the situation warrants. From N to Y in this chart and from BB to FF in this chart. If he knows of some favorable announcement that will appear in the 30 or 60 days, his operation will be timed so that the rise will culminate about that time. You have often noticed that a stock will sell at the highest price for many months on the very day when a stock dividend or some very bullish news appears in print. This is not a mere accident. The whole move is manufactured. Its purpose is to make money for inside interests, those who are operating in the stock in a large way, and they can only be done by fooling the public or by inducing the public to fool themselves. When an operator washes to attract buying from the public, he advertises his stocks on the tape by making many transactions, great activity, and by trading in a large number of shares. This creates what is termed as broad market. Exemplified on large scale by the chart. See the chart on screen from February 10th to March 2nd and the next chart between FF and NN, and on small scale by buying climaxes. See on January 9th in the charts on our screen. Great activity and breadth induces trading in large quantities by big operators on the floor and outside. Such a market enables the manipulators to unload a large line of stocks. When he wishes to accumulate a line, he raids the market for that stock, makes it look very weak, and gives it the appearance of heavy liquidation by sending in selling orders to a great number of brokers, illustrated on large scale on the charts in front of you. See December 16th and 17th, and in the next chart look at D to G. At M and U exemplify the idea in the case of smaller scale maneuvers. You say all this is unethical. You say it is cruel and crooked game. Very well, electricity can be very cruel, but you can take advantage of it. You can make it work for your benefit. Just so with the stock market and the composite man. Play the game as he plays it. I am telling you the rules. I am giving you the inside view. The large operator does not as a rule go into campaign unless he sees in prospect a movement of from 10 to 50 points. Livermore once told me he never touched anything unless there were at least 10 points in it according to his calculations. A typical market operations. Suppose a stock is fluctuating between 30 and 35 and an operator believes that it should sell at 60 in the next few weeks or months, and say he decides to accumulate. If he can 50,000 shares between 50 and 35, first he picks up what he can in the market by placing buying orders, say from 33 down to 30 on a scale. Then he forces the price down to around 30 by offering large amounts of stock and inducing flow traders and other people to sell their long holdings or go short because the stock looks weak. By putting the price down, he may sell 10,000 shares and buy 20,000. Hence, he has 10,000 shares long at the lower price of his range of accumulation. By keeping the stock low and depressed, he discourages other people from buying it and induces more short selling. He may, by various means, spread bullish report on the stock. All this helps him to buy. When he is thus buying and selling to accumulate, he necessarily causes the price to move up and down, forming the familiar trading range or congestion areas which appear frequently on figure charts. Finally, he completes his line. The stock now stands at 35 and he has absorbed 50,000 shares below that figure, and other operators have observed his accumulation and have taken on considerable lines for themselves. The floating supply of the stock below 35 is greatly reduced. At 36, the stock is prepared for the markup. It is ready to go up as soon as he is willing to allow it. Its action on the tape or on the vertical chart reveals the operator's intention. The formation of the figure chart shows this too, for reasons that will be explained. Next, suppose the above operator has, by means of his own manipulation, aided by favorable market condition, been able to mark the price of his stocks up to 50, and that he knows of the intention of the company's management to make a favorable announcement 5 days hence. In this intervening 5 sessions on the stock exchange, he will mark the price of that stock up with increasing rapidity. If the announcement is to be made after the close of the market on the 5th day, he will run the price up from say 56 to 60 on that day and close it at the highest point it has touched in the whole campaign, with great activity in the stock and a large volume of trading. The process of distributing calls for much publicity of that the attention of the public will be attracted to the stock. The rise to 50 started a whole crop of rumors. Brokers who are close to the bankers or the management of the companies have been trying to find out what is going on to make the stock so strong. Insiders have hinted vaguely that something good is coining out, and without knowing just that this expected favorable news is, the brokers have put their clients into it. Considerable outside public following has been gained during the rise. The market for the stock is broadening. When the announcement appears in the papers that evening and next morning, many people are thereby induced to place buying orders, and the market observes that morning 20,000 or 30,000 shares of the operator's holding. After this, the price may recede a few points, but he, having sold a large part of his line, is willing to take a small percentage of it back at 57 to 56. And after this has been accomplished and the activity has quieted down, he will mark the price up to 60 or 61 again. At that point, he either turns seller and markets the balance of his stocks on the way down, or he walks it up and down in the range of a few points from the top till he has completed his selling. This process of working a stock up or down within a certain range means nothing to most people, but to the tape reader and those who know how to interpret chart, it is evidence of important selling, and in many cases marks the culmination of the move. I will show you how this appears on some of the charts. The operator has now disposed of his entire line, and as the news is now known to public and many people have brought and thus taken the stocks off his hand, the stocks may be regarded as technically in a weak position, for it is in what is called weak hands. By this I mean it is held mostly by those who have bought at the top of a 30-point rise when the news was bullish. Most of these purchases being made on margins, the holder can be shaken out or tired out. The operators now see a chance to make a turn on the short side. So while the market is in this range of say 56 to 60, and after he has completed selling his long line, he sells short say 25,000 shares. In doing this, he makes the stock swing back and forth over this range, keeping good size supporting orders in around 56 to fool the floor traders, the specialists and the public who see on the floor and the tape evidence of his support on the reaction. Thus they are led to believe the stock is going still higher. When the operator has sold all of his 25,000 shares short, he cancels all of his buying orders. The specialist in the stock then tells some of the more important floor traders that the stock is in weak technical position and that there is no support for the next 8 or 10 points, and they all get together and raid it down to 50, at which point the operator covers his shorts. Charts made on the stock's fluctuation during these periods were shown on the video. This comes to the end of this video.